Baltimore has spent much of the current economic cycle as a slight underperformer relative to the U.S. apartment market as a whole. Is there anything in today's stats or in the near-term influences that suggest that that relationship is going to change? Welcome to Apartment Market Dynamics from MPF Research. I'm Greg Willett. Cameron McIntosh is here as well. We're going to take a trip to the Mid-Atlantic region and talk about Baltimore.
We think that rent growth serves as the most telling indicator of the apartment sector's overall health. Viewed from that perspective, Baltimore's recent results have been okay, but not stellar. Going back to early 2010, Baltimore logged total rent growth of 19.6%. That's solid, but it's below the national average of 26.5% recorded for the 100 biggest markets. Today's annual rent growth pace for new resident leases is in at 2.8%. That's a 3-year high by local standards, but again, not quite what we're seeing at the national level.
When you dig into the rent growth stats for Metro Baltimore, two comparatively weak spots jump out at you. The first place where there's not a lot of pricing power is in the south side suburbs along the I-95 corridor. In that zone, there's some negative spillover from Metro Washington, D.C.'s competitive leasing environment. Taking a look at that area's performance, annual rent growth is at just 0.9% in Ellicott City, Elkridge, 1% in Northwest Anne Arundel County, and 2.4% in Columbia, North Laurel. Pricing power also tends to be weak in the urban core, which has gotten enough new supply throughout this cycle to dampen rent growth. Effective rents for new leases actually slipped to 0.4% in downtown Baltimore during the past year. Compare those results to the rent change numbers seen in Baltimore's two key suburban locales on the north and northwest side. Rents are climbing at an annual pace of 4.5% in Owings Mills, Pikesville, Randallstown, and 3.9% in Towson, Hunt Valley.
Baltimore's apartment occupancy rate normally runs at 95 to 96%, and today's performance is right in line with that historical norm, coming in at 95.8%. Most of the Metro's available units are in recent completions, still moving through the initial lease-up phase.
Looking ahead, the volume of product that will be in the lease-up stage during the near term is pretty substantial by local standards. Ongoing building here totals 6,856 units, translating to 3.3% inventory growth. Downtown normally is the development hotspot in this metro, and that remains true. Roughly 2,800 units are under construction in the urban core. The area east of downtown is fairly active also, with about 1,300 units on the way.
Our base models for Baltimore's apartment market suggest that the area will be able to handle the product additions that are currently on the way. Expected occupancies hold about where it is now. Furthermore, anticipated rent growth creeps up a little from the current pace to just over the 3% mark.
I see some downside risk in that base case outlook, since it calls for rent growth to improve in those I-95 corridor submarkets and in the downtown area. That might be a stretch, though it's certainly not impossible. For now, we'll wrap up our look at Baltimore's apartment sector. I'm Greg Willett. He's Cameron McIntosh. Thanks for watching Apartment Market Dynamics from MPF Research.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.